There's a very famous regulatory economist named Alfred Kahn, and he actually worked as an advisor to Jimmy Carter. And he's kind of considered the godfather of deregulation back in the day with airlines and trucking and eventually electric power and utilities. But he actually wrote a book, a very famous textbook about utility regulation. And he very clearly says, like, hey, when market to book ratios are greater than one, it's very clear that the regulator's authorizing returns greater than the cost of equity. Interestingly, even when you read utility experts' writings on this issue, they will themselves say, yeah, market to book ratio greater than one means that the authorized rate of return is greater than the cost of equity. But they try to bury that in the actual regulatory proceeding. But they themselves will concede that fact.
What if we could lower electricity rates by 10% tomorrow with no meaningful impact on reliability? Recent research cited in ILSR's report Upcharge has exposed that electric customers in the U.S. are overpaying investor-owned utility shareholders by as much as $50 billion each year because state utility regulators are improving rates of return on capital investments by these utilities far above what it costs these companies to raise equity from the stock market. Joining me in November 2024 to talk about right-sizing utility rates of return is Mark Ellis, an independent consultant and senior fellow on utilities for the American Economic Liberties Project, and who previously served as former chief economist and chief of corporate strategy at Sempra, one of the country's largest investor-owned utilities. I'm John Farrell, director of the Energy Democracy Initiative at the Institute for Local Self-Reliance, and this is Local Energy Rules, a podcast about monopoly power, energy democracy, and how communities can take charge to transform the energy system. Mark, welcome to Local Energy Rules.
Great to be here. Thanks for hosting me.
Mark, I just want to start off like I do with all my guests, asking how did you get into this space? How did you get into utility finance and economics? What was interesting or motivating to you about that work?
There's kind of three nouns in there. There's utilities, finance, and economics. So I guess it started with utilities. My very first job between high school and college, I worked for LADWP, Los Angeles Department of Water and Power. I actually worked on the water side as a seasonal waterworks laborer. And basically, we were charged with clearing brush around their reservoir facilities in the San Fernando Valley. And it was my first exposure to infrastructure. And I was just fascinated by, these massive investments and all this activity that goes on that we basically kind of take for granted. Where does your water come from? Where does your power come from? Water comes out of the faucet. Power comes out of that little socket in the wall. And kind of just don't know everything that goes on upstream of that. And I've always just been fascinated by these public services and their interaction between sort of private business and the public interest. And so that was my first exposure to utilities. And in college, I studied mechanical engineering because where I went to school, they did not have civil engineering. I was always attracted to STEMmy type things. And so engineering was a good fit. And my very first job out of college, I ended up working for Sanyo Electric in Osaka, Japan, in a research lab in Osaka, Japan. And so most people of my generation know of Sanyo for their boom boxes and dorm fridges, but in Japan, they're known for their commercial and residential HVAC, air conditioning and ventilation, like the Tokyo Dome, which is the roof is suspended by air pressure. That's their HVAC system. And so this was in the early 90s, and the big environmental issue at that time was the ozone hole, not climate change. And the Montreal Protocol had just been signed, and all these refrigeration companies were researching alternative refrigeration technologies. And so that was what I was doing. I was in a lab in Osaka. Very interesting experience. I was the only foreigner in the dorm and in the lab, real immersion. And I had some spare time. The lab had a library, and I found these pamphlets from an organization called the World Watch Institute. I just read through all these different pamphlets, and about half of them focused on social issues and environmental issues, and about half of them focused on the energy, economic, and environment nexus. And I just found that so fascinating. And after reading, I probably read 30 or 40 of these pamphlets over the course of the year. And I decided that's what I want to do. I had this engineering background and I cared about the environment. And I liked the fact that sort of the economics explained how things work in the real world. And so I just decided that's what I wanted to do. And it was at that time I decided, hey, I want to go back to graduate school. And I ended up going to MIT's Technology and Policy program. But when I came back from Japan, I had about 9 months before I went back to school. And I ended up working for Southern California Edison in the first utility-sponsored demand-side management program. So this is going like this novel idea descended from Amy Levins and the concept of negawatts. California actually implemented it as policy. And I worked with industrial customers to help them reduce their energy usage and also their emissions. So California had a big initiative there to reduce smog. And so it was a lot of using electric technologies to help them reduce their various emissions. So that was sort of my exposure to utilities was both at DWP and then at Edison. And then at MIT was really my first exposure to economics and finance. And so what I like about economics, as I said, it's kind of explains the way things work. And then finance gives you the tools to make decisions around the way things work, right? So discounted cash flows and NPV and so forth. Interestingly, I kind of took my first finance course just because a friend of mine said, hey, I'm going to take it. You should take it with me. And I said, there's this accounting prerequisite and I don't have that. And he said, the teacher will waive it. You should take it. And I took this class and I just loved it. I just loved how it helped you, like I said, helped you put numbers to things and quantify things and make economic decisions. So that was sort of the introduction to the introduction. After I graduated from MIT, I ended up working for Mobil and then ExxonMobil in international gas and project finance. So developed a lot of skills around valuation and project modeling and economic analysis of projects and markets and just refining my toolkit. After the merger, I ended up joining McKinsey for a number of years and worked in their energy practice, both oil and gas and electric power and natural gas. Probably the most notable project I worked on was during the California energy crisis in 2000, 2001. We had a team working for the governor in Sacramento, and that was really exciting to kind of get an inside perspective and be a part of that process. In 2003, we had 2 kids and a third on the way, and my wife was like, enough traveling. You need to find a job. We were in Texas, and my wife and I are both originally from California, and she really wanted to move back. And I got this opportunity to join Sempra. And so I joined them in the beginning of 2004. And my very first project was like a strategy review that went to the board of directors in like two and a half months or 3 months after I got there. And I guess it went really well because after that, just sort of the work flowed to me. And it was very much, I was there for 15 years. And for most of that time, basically ran the strategy function while I was there. So anytime there was a novel question that the organization hadn't encountered before, it kind of came to me to help them figure it out. So did a lot of work on climate change, renewables, a lot of technology stuff, project valuation, understanding the economics of different markets and so forth. So that was sort of like my career and my interest in utilities and finance and economics.
So one of the things that is so valuable about your experience compared to many of the advocates who've been on this podcast, but also who we work with, is that you have this insider perspective as a chief of corporate strategy for Sempra. I'm just kind of curious, like, when was there a particular moment when you were working there that you realized just how much that the regulator approved rate of return for a utility motivated its behavior?
That's an interesting question. I think, like many things in life, you don't really fully understand something until you have some distance. And it was one of those things where you have observations and you have experiences and you do research. And it wasn't until I left and had time to reflect and do some more research that like, oh yeah, this is really a big issue. But I did, get some inkling. Probably the first major, data point was during the financial crisis in 2007, 2008. So Sempra, like most companies, they do project valuation and they have a discount rate or a hurdle rate that they use to evaluate their projects. And it's interesting, when I was at Exxon and Mobil, it was the same thing. They kind of like have a corporate number for that. And there's not a lot of like, you just accept it, right? It's just, oh, that's the hurdle rate or that's the discount rate you use. And you just kind of run with it. You don't really ask, well, where did that number come from? And what's the logic and analysis behind it? And so when I joined Sempra, they had these hurdle rates or discount rates that they use for project valuation that were kind of just like, oh, they didn't change them from year to year. It was like, oh, for this business, it's this. And then for that business, it's that. And it was what it was. And so during the financial crisis, like, markets took a nosedive and people were really like risk averse. And so the treasurer is like, hey, we have these hurdle rates that we use for all our project evaluation. And with all the changes in the market, they must have gone up. So what should they be revised to? And so that was, at that time, I was the chief economist, and that was my job to go chase that down.
I have some experience with discount rates and the way that they can influence economic decisions. So the fact that you're at this moment in time when so much is churning in the economy and being asked to like figure this out is just what a fascinating assignment.
Yeah, no, it was very interesting. And I'm one of these people who's like very thorough, and you go back to read all the analytical, all the research. And then, okay, I see this research that they did, but it's from, 1997. Let's update it to today kind of thing. So you pull all the data and replicate the studies and so forth. And long story short, I went back to them, I said, yeah, our cost of capital has gone up, but it's much lower than we ever thought it was. It took a long time to convince people because they're used to just like, oh, it's this number that they pulled out of a hat a few years ago and they're anchored to that. And, it came back and it's like, no, it's a lot lower than we thought it was. And you're going through the organization and kind of syndicating with different people. And I remember very distinctly having the conversation with the CFO at the time and telling him like, hey, our cost of capital is whatever it was. It's gone up, but it's so much lower than we thought it was. And then there was this conversation around like, oh, the utilities. And he's like, oh, they just earned their cost of capital. Like there's nothing there. I'm like, no. Their rate of return is much higher than their cost of capital. And you could almost see like the wheels spinning in his head. Like he was staring at me and like thinking. And long story short, at that time, Sempra was like the 14th largest utility, I think, in the country. And really, when I joined the company in 2004, until that time, the focus was really on the unregulated side. So that Sempra had just emerged from that energy crisis near bankruptcy, really pulled in their horns. And it was just like, oh, the utility is just a slow growth, sleepy business, kind of runs itself. So long story short, over the next decade, Sempra doubled down on the utilities and jettisoned almost all their unregulated businesses because they realized like, oh, these utilities, they're like the value generator in the company. And so Sempra, poured a ton of capital, particularly in SDG&E, tried to put as much capital as they could into SoCal Gas. They bought Encore. Then they kept the Mexico business, which has a lot of utility-like infrastructure, and also the LNG, which is very utility-like. But trading company, midstream, pipelines, renewables, they got in and then got out. But really, it was just like, okay, this rate of return really is like a value generator. It really drives behavior in the company. And it's not just around like, oh, this is how we create stock market value. It actually translates directly into their individual people's compensation, right? In terms of how executives are compensated, so forth. So you just saw like, okay, this is a big deal. This rate of return is the thing in utility regulation.
So several recent studies have shown that utility regulators have been granting utilities greater returns on equity investments than returns for similar low-risk investments in a competitive market, maybe even several percentage points higher. What is the cost, like to consumers, to the industry, of the failure by utility regulators to keep utility rates of return in sync with the cost of capital?
I think you're referring to the Carnegie Mellon and UC Berkeley papers.
Yes.
I think both of them give some estimates on the order, they're on the order of like, $10 billion. I think the Berkeley was like, oh, on average, $10 billion or $7 billion a year over the last 20 years or something is a historical look. I actually think both those estimates are quite a bit lower. I actually, in my testimony, I actually summarized like, okay, here's what the cost is. I've looked at it three different ways. So when I actually testify in these proceedings, I routinely come up with, hey, if you, instead of accepting the utilities requested, 10% plus or minus, you actually use their true market-based cost of capital, it comes out to around 10%. I've had 11%, I've had 9%, but on average, it's about 10%. Another way to think about the cost is in terms of an aggregate, it's about $50 billion a year. And another way to think about how to arrive at that is when you look at the stock market value of all the utilities, like the S&P 1500 Utilities Index, I did this analysis in August. It was about $1.2 billion, $1.215 billion in August. And the market to book ratio at that time was about 2.15. And so what that means, the market to book ratio above one, all the increment above one is basically sort of surplus above the cost of capital. So that 1.15 over 2.15 times a market cap of 1.2 works out to about $650 billion of market cap attributable to sort of this excess ROE. Utilities trade at a price to earnings ratio of about 18. So you take that 650 divided by 18, it works out to about $38 billion a year, but that's after tax. So the ROE is grossed up for taxes. When you gross it up for taxes, it comes out a little bit above $50 billion a year. So you can see that this is the excess that customers are paying per year to sort of line the pockets of utilities that's above the true cost of capital. There's some wrinkles to that analysis because it's like for the utilities index and they have some unregulated businesses. So it's overestimating, but the unregulated is only about 10%. And then the utilities index does not include a lot of companies like Berkshire Hathaway Energy is not in the utilities index because it's part of this big conglomerate. Puget Energy, there's a bunch of utilities that just aren't included because they're either privately owned or they're subsidiaries of companies that are like non-utility businesses. So that's another way to think about it. It's about $50 billion a year. Finally, you can just say, oh, utilities are earning a certain ROE every year. And then if they were actually what their true cost of equity is, you can look at that difference, and that's about 7 or 8%. So you can kind of calculate it different ways. But it's a big number on the order of tens of billions of dollars a year. On the market cap, right? Think about this. It's $650 billion of market cap is just a sort of excess earnings, right? So the market values the discounted present value of these future excess profits at $650 billion. It's not NVIDIA, right? But that's still a lot of money. $650 billion is a lot of money.
So could you've probably do this for folks all the time, but kind of a 101 level lesson in how most investor-owned utilities get paid. How does this inflated rate of return and the like excess market capitalization that we can see, like these measures that you have to see that in the market, how does that translate into higher bills for electric customers specifically? Like how do I, as a customer of Xcel Energy in Minnesota, end up paying more because the utility has a rate of return that's too high?
So I just mentioned the starting point, it's about 10%, right, is the excess. But utility rate making 101. So there's a principle, it's called cost of service regulation. So utilities are entitled and should earn their actual costs in terms of, so what they do is they take all their actual costs and they roll them up and they say that's your annual revenue requirement. And then there's another process to allocate them to different customer classes and then to the rate structure in terms of, how much is a fixed fee and how much is for the energy versus capacity or a fixed monthly fee. But just determine the revenue requirement is just supposed to be equal to the sum of their actual costs. So what are their actual costs? So we can think of the ongoing operating costs that are like consumed as they're paid for. Things like salaries or rent or fuel or purchased energy. There's kind of like, okay, I'm paying for them and then I'm just delivering them to customers and they're kind of buying them and I turn around and I sell them on. And basically the principle is, okay, whatever you paid, you just roll that up and pass it through in rates. So like I said, fuel, rent, salaries, things like that. But utilities don't just have these ongoing operating expenses. They also make major capital investments like pipelines and power plants and distribution and transmission lines and so forth. And so they're a big investment up front, but they don't recover them as they're incurred because they're actually consumed over many years. If you build a pipeline, it might run for 40 years. And so the term they use is they depreciate it over 40 years. So they'll take whatever, if the initial investment is $2 billion over 40 years, that's $50 billion a year, $50 million. So they'll just depreciate it over $50 million a year over 40 years. That depreciation they recover in rates as well. But if you think about it, nobody's going to invest like, oh, I'm going to put in $2 billion for this pipeline and I'm going to get $50 million a year. Like nobody would do that. There's a concept of the time value of money. You have to compensate people for investing up front and then earning money over time. So you can think of the depreciation as the return of capital, and then there's a return on capital. And we're all familiar with this. Like we pay an interest rate on our loan. We don't just pay the principal, we pay the interest. So the concept of the return on capital is analogous to the interest you pay on your loan. So you have the operating costs, you have depreciation, and then you have the return on capital. So that's the component of rate base. All those components, the operating costs and the depreciation, they're just kind of like you can look at invoices and accounting rules and you can figure them all out. So let's just focus on the return on capital and how do they calculate that? So basically for the return on capital, it's a function of how the utility finances that spending. So they have to raise money in the capital markets, both equity and debt. And for a variety of reasons, and I think these very sound reasons, the regulators want the utilities to have very strong credit ratings. So they say you can't put on too much debt. We want to make sure you have a very strong credit rating. So they tend to limit how much debt. And in practice today, it's about 50-50 debt and equity. So the return on capital for the debt component is just the interest rate. So they go and they issue bonds or they issue debt, right? And then there's loan agreements that say, this is your interest rate. And they kind of say, okay, that's what you're allowed to recover. Whatever interest you're paying, you can recover that from customers. And there's some wrinkles there, but that's the basic principle. And then the last part they raise in the stock market. So they go and they issue equity. The interesting thing about the stock market is you can't just look up what the cost of equity is. People give you capital and they're going to get paid out over time, but it's not like you can go and, if I want to look at the interest rate on a treasury bond or a corporate bond, I can just go to Bloomberg or Yahoo Finance or whatever and find that rate. But for equity, there is no analogous rate that you can look up. It's sort of embedded in investor expectations. So they have to come up with a return on equity for that last bit. And so that's the last component in the rate making process. And I know it's a bit long-winded, but that return on equity is grossed up for taxes, and it accounts for about 20%, give or take, of the overall rate. Just the return on equity plus the taxes that are grossed up is about 20% of the overall rate. So you can envision, like, okay, if that is too high, it adds up to a significant chunk of the rate.
I've got a quick math problem for you. What is 8 times 24? Don't worry, I'll give you a few seconds. Okay, got it? If you played along, you now know that it takes nearly 200 hours to research, record, and produce the 24 annual episodes of Local Energy Rules, and none of that time is free. You know the value of this podcast. That's why you're listening now. And if you're willing, we'd love to have you join us in supporting great insights about the energy system by visiting ilsr.org/donate and making a contribution. That's it. We aim to produce something valuable to all of us working to advance clean local energy. If you think we're doing it right, please consider a donation at ilsr.org/donate. Now, back to keeping our energy local. I saw a presentation that you gave, Mark, where you described utility finance as having customers pay off a 30-year mortgage, but in the end, the utility still owns the house. So I know this is a little bit of a tangent. We're going to come right back to rate of return, but why is it that in the way that we finance this stuff, that the utility still has title to all of the grid assets when the customers are done paying for them?
So first, I can't take credit for that analogy. That came from Matt Stoller, who's one of the founders and the research director at AELP, the American Economic Liberties Project. He's a very clever and creative and thoughtful guy. And so I have to give him credit for that analogy. But the reasons why the utility ends up owning everything, even though its customers already paid for it, I'm sure there's a bunch of legal reasons and has to do with, the franchise agreement and so forth that frankly, I don't have a lot of insight into. But just from a purely financial perspective, let's stretch the analogy a little bit further of the house. Imagine you have a house, but then you're constantly adding to it, investing more in it, right? So, I'm going to add on a room or I'm going to add on a story. And then you go back to your bank and you get some more loans, right? So you're constantly, even though you're paying off the old loan, you're constantly going back to the bank and getting more loans. And essentially, that's what's going on. The utility is always reinvesting and rate base is always growing. So they always have this sort of like, okay, we've put up this capital and therefore we own this asset because our capital is invested in it. So there's just this ongoing, they're always reinvesting, and stretch the analogy, they're adding stories or they're adding square footage or they're replacing the roof, all these capital investments that they're making over time that sort of keep their ownership intact.
Well, thanks for taking that tangent with me. I want to come back then to the rate of return. So we've talked about how the rate of return is set by regulators. You can't just look it up like you can an interest rate. It can have a very big impact on costs for customers because that payment to utilities is something like 20% of the total revenue requirement. So it's a big deal. How do we find the appropriate rate of return for a utility company that has captive customers? How would I know if I'd found the right number?
The good news is utilities are not the only place where you care about the cost of capital. This is something that's used throughout finance. And the first year MBA student, one of the first things they're going to learn about is like cost of capital and methodologies to calculate the cost of capital. Now, in practice, it's a little more nuanced. Like if you become a professional and do what I do, it's a little bit more complicated than what you learned in your first year MBA class, but not much. It's actually pretty straightforward. And there's well-established models going back, that were set up in the 1970s that were empirically validated and they're used throughout corporate finance. This isn't rocket science. It's nothing new or unique to utilities. There's well-established frameworks and models and methodologies and data sources that are available to do this. The two main models that are used in corporate finance are, one is called the CAPM or capital asset pricing model. It basically estimates the expected rate of return or cost of capital. Those two terms are synonymous as a function of the risk. There's a basic premise and foundational principle of finance that the more risk you take, the higher the expected return. And I think we're all kind of familiar with that. That's kind of commonsensical, but it's been proven empirically. Like you can look at the data and it's true. Like, higher risk assets earn higher returns, right? And so you leverage that insight and theory to estimate the cost of capital with the CAPM. And, there's estimates, there's methodologies to figure out, well, how do you measure the risk and so forth. And so that's one methodology. Another one is called the discounted cash flow model, where you can come up with like, okay, what are the expected cash flows over time into perpetuity for this business? And then you can say, well, what am I paying for today? And i.e. the stock price. And you can, figure out, okay, what's the discount rate that equates the discounted cash flows to the current stock price? And that's another very commonly used methodology in corporate finance. And those are the two basic methodologies that are used to estimate the cost of capital. So for the discounted cash flow, one thing that's interesting, because you could say, well, the discounted cash flow is really challenging because I don't know what the growth rate is going to be over the long term for this company. Like think of Tesla. Does anybody know what Tesla's long-term growth rate is? It's like, somebody could say it's going to be negative and somebody could say it's going to be 10%. And both of them are probably equally valid. Interestingly, for utilities, we have 100 years of data on utility growth rates. And what you find is basically they all grow at inflation. Their dividends grow at inflation. They have grown at inflation for 100 years. And you think about it, kind of makes sense, right? The utilities just grow with the economy overall. And we can get into the details about why it doesn't grow, why they don't grow with GDP. But for utilities, we have very high confidence that their growth rate is going to be bounded over the long term. And so there's not a lot of dispute around what the valuation should be. So you can use these two models to come up with, okay, here are my cost of capital estimates. And one thing is if you're using these two different models and you're getting dramatically different results, then that tells you something's wrong with your analysis, right? So you have these models that come up with an estimate, and then you can corroborate them using different methodologies. So one is, like I said, the utility industry is not the only place that people care about the cost of capital. So Wall Street firms like BlackRock and JP Morgan, Wells Fargo, and asset managers, they produce these things that are called capital market assumption reports. And they produce them at least annually, but sometimes as frequently as every quarter, even every month, of their expected return for the market as a whole. And one of the things I do periodically is I do a survey of all these. I literally pull hundreds of these reports and I line up what are their forecasts for the market return. And they routinely fall between like 4 and 8%, and they average around 6 or 7%. So these are companies or firms that collectively are managing trillions of dollars of other people's money, right? And they have very large staffs of sophisticated economists and analysts producing these reports. And they have a huge incentive to be accurate. They don't have an incentive to overstate or understate because their investors are going to judge them on their accuracy. And so they come up with these numbers around, 6%, say for the market, 6 to 7% for the market as a whole. Now, everybody recognizes that, hey, utilities are lower risk than the market as a whole. So their expected return, i.e. their cost of equity, should be less, right? Is it 100 basis? Is it 1% less, 2% less, 3% less? You can refine, sharpen your pencil to figure that out. But it's not 9 or 10%, which is higher. In fact, when you run these surveys, nobody's higher than like 8% for the market as a whole. And yet utilities are saying, oh no, our cost of capital is 10%, even though we're lower risk. So there's a huge disconnect just there. So that's one way that's a way to corroborate. So you have these models, and then you can corroborate it with like, what are the experts saying? And then another way to corroborate is to look at what is called the market to book ratio, which is the ratio of essentially what the market price is for the market capitalization for the utility stock. In other words, what investors are willing to pay versus how much equity, how much capital the utility actually invested. And that's what's referred to as the market to book ratio. And so you look at, and you can compare the two. And I mentioned before, it's about 2.15 as of August. It's been hovering around 2 for 15 years. And essentially what that means is, very intuitively, if I paid $100 for an asset that pays out $10 a year into perpetuity, my return is 10%. Now, if somebody comes along and says, hey, I'm going to pay $200 for that, just mathematically, we know their return has to be lower, right? If they're paying twice as much for the same $10 a year cash flow stream, then their return can't be 10%. Mathematically, it has to be lower. So essentially, with the market to book ratio is telling us that, hey, investors are willing to accept a return dramatically lower than that 10% ROE. right? So the investor expectation is the true cost of equity, not what the regulator assigns. So that's another thing. The market to book ratio is like the key. It's directly observable. It's unequivocal. You can look at that and say, like, are investors expecting something, a lower return or a higher return, right? That tells us is the authorized rate of return higher or lower than the market expectation. And this is not something new. There's a very famous regulatory economist named Alfred Kahn, and he actually worked as an advisor to Jimmy Carter. And he's kind of considered the godfather of deregulation back in the day with airlines and trucking and eventually electric power and utilities. But he actually wrote a book, a very famous textbook about utility regulation. And he very clearly says, like, hey, when market to book ratios are greater than 1, it's very clear that the regulator's authorizing returns greater than the cost of equity. Interestingly, even when you read utility experts' writings on this issue, they will themselves say, yeah, market to book ratio greater than 1 means that the authorized rate of return is greater than the cost of equity. But they try to bury that in the actual regulatory proceeding. But they themselves will concede that fact.
We're going to take a short break. When we come back, Mark and I talk about how excessive rates of return shape utility behavior, whether utility regulators have ever gotten this right, and 5 key steps advocates can follow to start winning fairer rates of return. You're listening to a Local Energy Rules interview with Mark Ellis, an independent consultant and senior fellow on utilities for the American Economic Liberties Project, and who formerly served as chief economist and chief of corporate strategy at Sempra, one of the country's largest investor-owned utilities. Hey, thanks for listening to Local Energy Rules. We're so glad you're here. If you like what you've heard, please help other folks find us by giving the show a rating and review on Apple Podcasts or Spotify. 5 stars if you think we've earned it. As a bonus, I'll gladly read your review aloud on the show if it includes an energy-related joke or pun. Now, back to the program. I really appreciate you laying this out in such detail, Mark, because for someone who has worked a long time on the policy side of things and thought about, like, how do we motivate utilities to do things? I think it's kind of like you were saying about your fascination with economics and finance and realizing economics can explain how things are happening and finance is a tool you can use to manipulate it. And here we have very clearly this financial tool that is very clearly driving investment in a particular direction. And actually, that's one of the things I wanted to ask you about here is not only does an excessive rate of return increase costs for customers unnecessarily, but it also motivates utilities to behave in a certain way. And can you talk a little bit about that?
Yeah. So I'm going to use the market to book as a launching point again. So in practical terms, what does this mean? So in practical terms, it means, like, for every dollar of shareholder capital that the utilities invest, it turns into $2 plus, right? 2.15 currently in their share price. So if somebody came to you and said, hey, give me $1, I'll give you 2 in your retirement account. You'd be like, okay, can I give you 2? Can I give you 10? Can I give you $1 million? Right? So essentially, that's what the utilities are doing. That's what the utilities do. It's like, if I spend $1 and it turns into 2, I'm just going to do that as much as I can. So that has a number of sort of incremental impacts, right? So 1, it's just an incentive to, like, invest as much as possible. And then 2, it crowds out other things, right? Because it's so attractive. Nobody has a deal, this 2-for-1 deal, like no other business, virtually no other business, and it's almost guaranteed, right? So other companies have opportunities to invest and, like, oh, if I invest this, I'm going to double my money, but it's not as risk-free as it is for the utilities. It's not totally risk-free, but virtually risk-free for utility. Like, once it's approved by the regulator, as long as they operate it safely and so forth, they're going to make that value. And it's very clear. You can see it, like, oh, when a utility gets regulatory approval for something, their stock price will go up correspondingly. So 2 things. 1, it creates this incentive to spend more, which creates this rate spiral. But 2, it crowds out other things. So if I want you to do efficiency, or I want you to focus on other things that don't necessarily entail capital expenditure, it just is not very attractive, because there's nothing like, oh, I spend $2 billion on the new transmission line, and that's $1 billion of shareholder equity, which turns into $2 billion in my market cap, right? Like, that's just an amazing deal. So it's just the huge driver. I've been syndicating this idea with various parties to try to get people more interested in rate of return, because it's such a big driver of utility behavior. And one of our colleagues, Dave Pomerantz from Energy and Policy Institute, I think you know him, he referred to it as, rate of return is the skeleton key. It kind of like unlocks everything else you're trying to do with utilities. And the idea is if you can reduce that incentive, so it's not 2 for 1, it's 1.1 or 1.05 to 1, right? Or 1, right? So they're just neutral. Then all of a sudden you can, all these other things you want them to do start to look more interesting. You can have more influence over that, and they will prioritize them more appropriately.
One of the things that amazed me, I think it was a chart from one of your presentations looking at the historic market to book ratio. And then they're also in the Carnegie Mellon and the Berkeley studies, both of them have kind of a time analysis. Those ones go back to the 70s. I think your market to book one went back to like the 1940s. And if I look at those two things, I'm left with this question: have utility regulators ever gotten rate of return right? Because it seems like there was this moment in the 1970s when the rates of return weren't excessive. But that was sort of a unique moment in history when inflation and interest rates had skyrocketed. Was that just a coincidence that it seemed like it was in line at that time? Like, was there any real strong action? Do we have a point in time to look back at and say, this is when they got it right? Or is it just that just happened because of the unique circumstances of the time?
Yeah, I don't know the exact answer. My personal perspective is it was just coincidence. Like when you look at the data, there's never a period where the market to book is hovering around 1.0. It's either well above or well below, right? So that period in the 70s, the chart is a little misleading because it's hovering around 0.5, 0.7. Right? That's too low, right? And utility said like, hey, this is a legitimate concern. I believe they had a point. Now, I was a child then, so I don't know all the regulatory history. There was rapid inflation. There was cost overruns related to nuclear and other things. So who knows, maybe it was deserved at that time. But interestingly, the utility experts all at that time were saying, like, I have a book here that says the market to book ratio is a guide to regulators. Like these were experts testifying on behalf of utilities saying, like, got to be at least 1, got to get it up to 1, got it, right? That was the argument at that time. Interestingly, one person who wrote a paper on this is Peter Navarro, the Trump advisor who's now under consideration for National Economic Council. I have a paper from him and he's like, yeah, the market to book ratio of 1.0, that's where we need to be. He wrote in 1981 when they were trading below that. This is well known, like 1.0 is the standard. I think the regulators have just never, like when you look at the data, they never were able to kind of get it right. It doesn't mean they couldn't. I don't know why. This isn't rocket science finance. In other words, sort of the regulatory groundwork around like, the rate of return should be equal to the cost of capital. The rate base should be equal to the actual investment. That all dates to the 40s. NPV and discounted cash flow all dates to the 1930s. So you'd think from the 50s on, they should be able to kind of like drive by braille, like, when market to book is too high, we're going to reduce the ROE. When market to book is too low, we're going to increase the ROE. But they haven't been able to do that. And my experience in regulatory proceedings, I've only been doing this 4 or 5 years. Today, the state of the art and the quality of the testimony just isn't very good. Like they don't emphasize this very much, right? This idea like, the market to book is a guide to regulators. It's like, come on, people, this is like basic finance, but you actually have to introduce it. I mentioned before, for example, there's 2 basic models that are used in corporate finance, the DCF and the CAPM. In regulatory proceedings, they have like these whole other models that are only used in regulatory, like for the cost of capital, for the cost of equity, that are only used in regulatory proceedings. Nowhere else do you find these in finance. And the crazy thing about them is, what are they doing? What they do is they're models that are basically looking at the authorized ROE from other regulatory proceedings and saying, that's our cost of equity. And it's like, well, anybody who has any logical sense, like, no, that's authorized rate of return. It may or may not be equal to your cost of equity. There's no reason to assume that it is. These are still widely used in regulatory proceedings and widely accepted in regulatory proceedings. And not only the widely used by the utilities, they're widely used by experts testifying on behalf of consumer advocates and third-party intervenors. And I look at this and it's just like, I want to pull my hair out. To its credit, the FERC did a very extensive review of all these models a few years ago. And they basically said, those models that are referencing other authorized ROEs from other proceedings, they're circular. I think the language they use is they defy general financial logic. And they said, you can't use these anymore. So there's 2 models. One is based on authorized ROEs. One is based on forecast ROEs, which are essentially authorized ROEs, called the risk premium model and the expected earnings model. And they said, you can't use these anymore in FERC proceedings. FERC still has some room to do, but at least they recognize like these circular models, like just toss them out. They make They defy general financial logic. But sadly, they're still widely used and widely accepted in these regulatory proceedings. So I don't understand why, given the stakes, right? 10% of rates, $50 billion a year, like why the state of the art is so poor. And that's something I'm trying to change. Is just like, this isn't complicated. This is, like I said, a first year MBA student knows how to do this. We just got to up our game and start bringing some 50-year-old finance into the modern regulatory arena.
I want to ask you two more questions in the time we have. One is, because you said this in your presentation, not just like the dollars that are at stake, but kind of like, what could we do if we fix this? Because one of the things that you said I thought was really helpful is, yeah, you could just reduce rates, which in some places like California obviously would be a huge relief given the upward pressure there've been. But it also, you could make big investments in other things. So I just wanted you to touch on that briefly, kind of like, how else could we be using those resources that are right now just sort of giving excessive benefits to shareholders? What else could we be doing with the money that is being spent this way?
I talked before about, the buildup of the revenue requirement. There's sort of ongoing operating costs, and then there's the capital. So when you kind of run the numbers, the ongoing operating costs are about 50% of the rate, give or take, right? It varies. And then the capital, right? The return of and on capital is about 50% of the rate. And so if the potential savings is about 10% of the rate, then it's about 20% of the total capital, right? So if you can reduce your capital cost by 20%, that means when you take the inverse of that, it means every dollar of revenue you raise for capital investment could go 25% further. So the idea is like, I could take the same amount of revenue and I can build 25% more stuff, whatever that stuff is, right? Upgraded distribution or EV charging or what have you. Like every utility is going to be different and every jurisdiction is going to make those decisions. And those are a separate decision, but you can expand the pie, right? You can build more stuff and you can do anything in between. Like, I'll take half of the savings and I'll reinvest it, right? Get 10% more or 12.5% more stuff. And then the other 10%, I'm going to reduce rates 5%. You can adjust that knob any way you want, but 25% more stuff is pretty compelling for the same amount of money.
Absolutely. So let's come back to this issue of how do we get this right? So you have commissions right now that are maybe looking at models that, as FERC described, are defying general financial logic in terms of making decisions. You have sometimes consumer advocates, people like, on our side of affordability and good investment, maybe even referencing those same bad models. What is it that we need to do to correct this problem? Obviously, we need to be advocating in rate cases when this stuff is coming up, but what do we need to do in order to get it right? And how can we be coordinating? Because it sounds like this is happening everywhere, not just in one particular place.
So in addition to testifying on this is something that I'm actively pursuing. And I have like a whole inventory of different projects I'm working on to try to fix this problem more systematically, right? So the first one is just like better testimony. Consumer advocate, witnesses testifying on behalf of consumers and environmental organizations, whether they're public or third party, like they should not be using the risk premium model. And if you were hiring an expert who uses the risk premium model, they should be disqualified. They clearly do not understand the most basic principles of finance and regulatory economics, and the legal standard of the rate of return should be equal to the cost of capital. So just better testimony. Interestingly, I had a recent experience in California, which the decision didn't go my way, but in the meeting approving the decision, one of the commissioners got up and gave a 6-minute speech, basically endorsing like, yeah, market to book ratios are telling us that our authorized rates of return are too high and we need to bring them down. People are interested. It was in California. It was on October 17th and there's video and you can watch it. It's at 4720 on the video if you want to hear it yourself. But that was very rewarding. It's like, okay, the message got through at least to one commissioner. Interestingly, one of the stock analysts covering California utilities noted like, hey, we're happy with the decision, but the commissioner's comments were not helpful. Like specifically saying like, reintroducing the market to book ratio into the regulatory discussion is not helpful. So like that's progress to me. It's like, hey, the message is getting through. So better testimony can make a difference. The second one is I've observed in various proceedings is you will find in California, I think in this recent proceeding, there were 6 different parties submitting testimony on a rate of return. Now, all these parties want the same thing. They want a lower rate of return. And I suspect that like one party, Turn, doesn't have a dramatically different view than EDF on like what the beta should be or the equity risk premium. It's just like an artifact of they hired different experts. To me, that just doesn't make any sense. Like, pick one expert, because inevitably what the utility will do is say, like, hey, we're asking for 10 and these intervenors are all like all over the map. They can't even agree among themselves. Just go with what we say. It just makes their job, it makes the utility's job easier. It makes the regulator's job harder because they have so much more evidence to review. That's just like, how are they to decide, like, oh, whose beta estimate or equity risk premium estimate or growth forecast in the discounted cash flow is better? It just, why don't you coordinate, put all your wood behind one arrow, pick the best expert and go with that. So stop fighting among yourselves. It's really silly. They can coordinate better. Another thing is, unlike other issues, rate of return is the same from utility to utility within the same state and across states. It's, from state to state, it doesn't change. Like, every state is going to have very different policies around rooftop solar and energy metering and so forth. And like, you need to have state specific knowledge to participate in those proceedings. Rate of return is cookie cutter. Literally, you can take my testimony, you could take the utility expert's testimony from one state to the next, and it's virtually identical. The only thing that changes is the peer groups, right? But it's a lot of finding and replacing, right? The testimony, it's very similar. So there's huge economies of scale and scope and just learning. My experience is a lot of intervenors, they're lawyers, and they're lawyers because they don't like numbers. It's like a relay race where you're handing off the baton, right? So I can do really good testimony, but if my lawyer doesn't really understand the material, they can't write good briefs and they can't do good cross. And it's sad because it's like, if you roll up your sleeves and spend the time on one or two proceedings, you're good to go. Like, you can do a great job on hundreds of proceedings after that. And it just seems to me like that there's a real opportunity to like build more expertise internally on this issue so that you can be more effective. And obviously you can't do this on every issue, but rate of return, 10% of rates. It's like, I challenge you to find anything that comes remotely close to even 1% rate reduction. And here you get 10% rate reduction. So there's huge value in like building expertise. So that's what the intervenors can do a little bit better, I think, is coordinate and just build their internal expertise and be more judicious and like really getting good testimony and fighting this issue. Another thing they can do is they could appeal these decisions. In my experience, the utilities will definitely appeal a rate of return decision they don't like, but the intervenors almost never do. They kind of just say, oh, we tried, and they move on, right? Like, oh, the utility asked for 10.5%, and we submitted erroneously 9%, and the regulator approved 10. And, oh, we got 50 basis points out of it. Great. And it's like, yeah, but you're still overcharging customers by $1 billion a year. Like, this is crazy. Appeal it and keep appealing it, and, build a war chest to appeal it. To me, that just seems like you got to keep fighting. So that's something the intervenors can do a little bit better. I have a bunch of ideas about things that sort of outside sort of the regulatory arena that can be done, but I'll pause there.
That's really great. I'm just going to review those really quick, because I think you gave a really concise example of what people who want to intervene in the regulatory proceeding. First of all, testify, disqualify experts that use bad models, coordinate with others on cases, coordinate nationally, because as you say, this is cookie cutter, and appeal bad decisions. That's pretty solid 5 things that we can all be doing better to win on this. I'd love to hear some of your ideas for doing this outside the regulatory system. What else can we do to move people?
I've talked to a number of attorneys around, like, are there potential lawsuits on this? It's really challenging, right? To like have a lawsuit to second guess a regulatory decision. There's something called the filed rate doctrine and the state action doctrine, but something we continue to explore. I'm really working with just one attorney on the class action, but I've talked to a number of them. And so when they do these class actions, they run it through 2 filters. One is there a case, and how do I get paid? And so like, oh, I have a product liability or like RealPage or, collusion or whatever. It's very clear, like, okay, the remedy is you get the claw back from past overcharges, right? That's the remedy. And then you get a percentage of that. So, and when they think about it, they do it in the reverse. They think, how do I get paid? And then they'll figure out whether they get a case. They look at utilities as like state action, filed rate doctrine. There's no way for me to get paid. And so they just stop. The one I'm most interested in, and this is kind of the newest idea, is when utilities were created, they kind of adhered a monopoly on the equity financing to the operational monopoly. And that kind of made sense, like back in Thomas Edison's day, like when capital markets were not sophisticated, And you needed these big holding companies that could raise a lot of capital and deploy a lot of capital quickly. But that's not the case today. And you think about it, when the utility goes and says, oh, I'm going to go raise debt, it's just assumed and it's just expected, like, oh, you're going to go to market. It's not like you go to your parent company and say, hey, lend me money, whatever, charge, tell me what the interest rate is and I'll ask for that from the regulator. Like, it just doesn't enter anybody's head to do that. They're like, of course you're going to, issue bonds and the market will determine the interest rate on the bonds, or you're going to go, maybe you go to a bank or a lender, a private lender, but you're still going to shop it. Like, there's an expectation you go to market. You don't just go to the parent. Why don't they do the same thing for the equity? We know that investors are willing to accept a lower rate of return, not just from the market to book ratio. We also know from transactions. Think about this. Elite, right? Owner of Minnesota Power is being sold, right? To GIP and CPP. So GIP is a private equity and CPP is a Canadian pension fund. And they're paying, I think, 1.6 times book. So think about what's going on with that transaction. You have this private entity coming in and saying, hey, we're going to pay 1.6 times book. And I think it ends up being like over $1 billion sort of over book value that flows to elite shareholders, right? So they get this $1 billion windfall if this transaction goes through. So what is that $1 billion windfall for? It's not for past performance, because they already got rewarded for the past performance in the rate of return, that 10% that they were earning all those years. It's not for future performance, because they're selling. Like, they're not doing anything in the future. So they're getting this $1 billion windfall purely as an artifact. That $1 billion windfall is just the present value of the cash flows that are coming out of customer pockets, right? That are above sort of the actual cost of capital, that $1 billion windfall. That's just a regulatory decision. So CPP and GPP are revealing through their willingness to pay that they're 1.6 times book, that they're willing to accept a much lower rate of return than the 10% authorized ROE, right? In these transactions, one of the issues that they founder on is they don't get regulatory approval because they can't demonstrate any customer benefit, right? So CPP and GIP aren't saying like, oh, I'm going to reduce rates. They're not promising that at all. They're just saying, I'm just going to take over the business as it is, right? So there's no real customer benefit. So why doesn't a third party come in and say, hey, I will contribute equity, but at book value, and I will accept, not 10%. I will charge you just 7% plus a tax gross up, which may or may not be the same as whatever. And the difference between the 10% that you've authorized and that 7% will go to reduced rates. It all flows to customers. And like, what's the regulator going to say? Like, no, I don't want your cheaper money because I want to keep rates high. And again, they do this for debt. There's no legal or regulatory prohibition from a regulator requiring a utility to go to market for their equity. And so to me, this seems like a very interesting idea. Is like, there's this concept that regulation is a surrogate for competition. But implicit in that is competition where you can have it is always better, right? That's the norm. Well, you can have competition for the equity. And so just create, an auction process. There's all kinds of ways you can create market competition for the provision of equity. They just don't do it. That's an idea that I'm particularly intrigued about. And just trying to, talking to people like from a legal perspective and from investing perspective, like, could this work and what would it take and so forth? And hopeful to make some progress on that in the new year.
It's amazing. It reminds me of a great conversation I had a couple years ago with Scott Hempling, who was recently an administrative law judge at FERC. And he and I talked about it in the context of municipal takeover bids, right? Where cities are trying to create a public power agency and buy out the incumbent private utility. And he said that these acquisition prices are essentially just the utility profiting off the publicly granted monopoly. It's the writ of having captive customers that they are selling to the next bidder to no benefit for the ultimate consumers. So I'm really intrigued to see where your work comes out of that, because I think it's such a persistent problem, this idea that we have sort of privatized this public service and we are letting shareholders essentially wring value out of that could be returned to customers ideally, and that we should have regulators really looking out for opportunities to return to customers.
Yeah, Scott Hempling, great admirer of his writing, and he's been a huge inspiration on a lot of my thinking. I'm glad that you brought him up. The last idea about this private investment, that one, it sounds like so natural. Like, yeah, if CPP and GRP are willing to put money in it, like, why wouldn't they do this? Like, why don't they just do this end run So I have an old college dorm mate and teammate who works at GIP. And so I met with him and I asked him about this. And he says, like, it makes sense. But he says we don't hold the utility for the long term. So we're going to buy it. We're going to try to put as much capital into it as we can. And then we're going to sell it. Right? Because it's all based on like they get their money back if they can put more capital, right? Because it's earning that 10%. That's how they grow the value. He said, interestingly, he said CPP, they're probably going to hold it long term. Basically, his point is like, this makes sense, but the investor who would do it, it's like a needle in a haystack because you need an investor, one, who's going to hold it for the long term, which means it's a retirement fund, basically. But two, they need to have a team internally that can do this work. Most retirement, like CalSTARS and CalPERS, they partner with GIP. Like they don't do direct investing themselves. They partner with other firms to do it for them. And so he says it's really, that's going to be your challenge, is like finding some renegade. And then they said the third one is like, we do deals with utilities. We're not in the business of doing hostile deals. We know this is poking the bear. And so he says you need somebody who's like, has a lot of money, has a long-term investment horizon, and has internal capability and doesn't mind rocking the boat. So it's a challenge. But I think, the good thing is if you can get one, the floodgates will open, because once one firm does it and proves like, yeah, this works, every other firm's going to be like, okay, I can do it now because it's a proven model.
Well, Mark, thank you for taking so much time with me to talk through this issue about rate of return, kind of giving us these hallmarks of like market to book ratio and other ways that ordinary folks can use Yahoo Finance to find out more information about where their utility is.
Yep.
But also for helping to provide some inspiration for advocates that are working on these issues of energy and affordability and thinking about clean energy investment. There's a big opportunity here, like money being left on the table for shareholders in excess of what would be necessary to bring that capital into the utility sector. So I think there's so much we can learn from what you're doing and just so appreciate the work that you're putting in.
Thank you very much. It's been great to speak with you, John.
Thank you so much for listening to this episode of Local Energy Rules discussing utility rates of return with Mark Ellis, an independent consultant and senior fellow on utilities for the American Economic Liberties Project, and who formerly served as chief economist and chief of corporate strategy at Sempra, one of the country's largest investor-owned utilities. On the show page, look for links to Mark's recent testimony in California and the favorable reply from one of the utility commissioners regarding market-to-book ratio. We'll also have links to ILSR's report on monopoly utility abuses, Upcharge, which includes the 2 studies on excessive utility rate of return, and to my podcast with Scott Hempling. For those wanting a deep dive, we'll also include a link to the book on regulation by Alfred Kahn and the 1980s era paper by Peter Navarro emphasizing the appropriate market-to-book ratio for regulated utilities. Local Energy Rules is produced by myself and Ingrid Burson, with editing provided by audio engineer Drew Birschbach. Tune back into Local Energy Rules every 2 weeks to hear how we can take on concentrated power to transform the energy system. Until next time, keep your energy local, and thanks for listening.